Hey, this is Cory Boldroff, the real estate guy, doing this monthly market update so that you can be informed with real stats and facts about where the market is and where we think it's headed. So with no further ado, let's get started. So I want to start this monthly market update with a quote from Bill McBride with Calculated Risk. It says, "My sense is that the Case-Shiller national annual growth rate of 19.7% is probably close to a peak, and that year over year price increases will slow later this year." So I want to put this in context. This is by no means calling that we're going to be having a depreciated market come into a crash. This is nearly stating that we've had an annual increase of growth from 5 up to 20% year over year for the last 10 years, and that we're maybe possibly coming to a peak and going to start to plateau. By no means do we see a crash or depreciating market. Look at it another way. In July of 2021, year-over-year house appreciation, the Federal Housing Finance Agency estimated about 19.2% nationwide. CoreLogic saw about 18%, and the SB Case-Shiller US Index, as we said, had a 19.7% increase in growth. So you can see, if you were asked, should you have bought a home 5 years ago, 2 years ago? Right now, if everyone was asked that question, you probably would say yes, and you might even say, I'll take 2. When we look at it nationwide, the price appreciation year over year on the second quarter of 2021, we say California 20.2%. We even see places like Utah, Arizona, Colorado, Montana see above 20% appreciation growth. And that is because a lot of people have been moving out of these urban areas, out of these well-populated states, and moving into less populated states where prices were a lot lower to begin with. I want to go to a quote with Ivy Zellman with Zellman & Associates. "Closings are set to decline roughly 10% year over year in the second half of 2021, and home price appreciation is on the cusp of flipping to a decelerating trend." Again, this is because just of lack of inventory, that we have such a shortage of inventory, and that is one of the main reasons we're seeing such a high appreciation growth. And there's a lot of buyer demand. A lot of demand has changed over this COVID period of people not wanting to be in the highly populated areas, people being able to work from home, or people finding different things important after what we've gone through with the pandemic. So again, it's not that we're going to be decelerating in prices or depreciation, but just decelerating in appreciation. So we're not going to have this huge spike. It's probably going to level off. But to show you kind of where we're at, the average 40-year appreciation rate is anywhere from 3 to 5%. This year, we're sitting about an average of 3.8, or before this year, we were sitting about an average of 3.8%. This year, with the spike up, we went up to 4.1% of an average 40-year. So to go through this year, in the last quarter, we're going to look at 11.7% appreciation growth. Next year, they're predicting at 5.82%. The following year, 3.9%. Following year 3.5, the following year 3.5. So if you look at it, it's not that we're seeing a depreciation in values, we're just seeing a decline in the astronomical growth that we've seen over these last 2 years. Some of this was because the government pumped in $4 trillion into the economy. We've also seen people moving out of those highly populated areas, which are extremely high price and value. They're moving 20 to 30 and sometimes even out of state, where now their money allows them to buy a lot better value. So they're willing to spend more money on those houses, maybe even willing to overpay them based on appraised value, because they're still getting a lot better deal and a lot better value compared to where they're moving from. When we look at the expected home value change, if we calculate it over a 5-year period, we're looking at about an average of 5.7% appreciation growth and a total of 31% over the 5-year period. So meaning if you bought a home today, the experts are predicting that your house is going to be worth 31% higher 5 years from now. So if you think it's not affordable now, with interest rates being extremely low, as interest rates continue to climb and prices continue to climb, it's going to be a lot less affordable in the next 5 years to come. Now, some of this appreciation growth, you have to put inflation into context with it. So if inflation goes up by 5.5% and you increase your house by 5.5%, you really had a negative, positive cash flow appreciation growth. So it's really that inflation is causing prices to go up or helping prices go up. So what about the fourth quarter? Where are we headed? Well, I will say the experts are having a very, very hard time predicting exactly what's going to happen. A lot of it has to do with coming off of 2 years of the pandemic. There is no such thing as a normal market right now. Normal trends are not there. Things that normally happen year over year in the last 40 years didn't happen the last 2 years. So some of that leaves them with the unknown. I want to take a quote from Diana Olick with CNBC's real estate correspondent. Fall is usually the start of the slower season for the housing market, but nothing is usual in today's pandemic-driven housing market. Potential home buyers are seeing a slight rise in inventory and consequently rushing back into the fray. Mortgage applications to purchase a home jumped 7% last week from the previous week. That is the highest level since the April of this year. Now, I can say in my own business, we were out there showing homes and buyers were getting discouraged in the end of 2020 and even the beginning of 2021. I kept telling them, just wait till August, there's going to be a burst of inventory. Yes, there definitely was a rise in inventory, but not the burst that we were thinking of. But it did cause a lot of those buyers who got discouraged to come back into the housing market. When we look at home sales, very difficult to forecast when trying to predict home sales. So this is the amount of homes that sell each year, year over year. So 2019 was a very strong year, especially historically speaking. It was one of the best we've had in the last 10 years. And you can see there's little spike ups throughout the year, but generally they hold pretty strong and pretty consistent. We came into the pandemic in 2020, which is the orange mark. We obviously fell down dramatically into a peak or into a valley during the shutdowns, the lockdowns, where we were not allowed to show homes, buyers weren't allowed to buy homes. And then we saw that built up demand and a lot of people changing, their lifestyles, their families, where they're living, where they're working, and it shot up and all the way and led us through the end of 2020. So in 2021, we came from a huge mass peak and we've kind of leveled off and had a little dip. But when comparing to 2019, we're still a lot stronger and a lot higher than we were. When we look at 2020, was nothing normal like 2019. 2019 was a pretty normal year, then the pandemic hit, and you can just again see where there was nothing normal about that home sales trend. So it looks like things are slowing down, but that comes from this built up peak in demand that we had in 2020. But again, when we really look at it compared to 2019, we're still in the millions of homes sold higher than we were in 2018. And 2018 was a very strong year, especially when we're looking at the last 10 years. So you can see, other than 2017, 2019 was one of the highest home sale years we've had. A lot of this has to do with interest rates climbing down. People kind of saw the appreciations happen in 2015, 16, and 17. We had very strong appreciation years. Some of those were even in double digits. So it's led us to where we are today. So again, when we look at home sales, even if they start plateauing, we're still a lot higher than we were in 2019. Now they could peak up with inventory rising. It's just going to really depend on that buyer demand. I know historically, as families get back into school, there's about a 3-week period of lull where people aren't buying, people aren't looking. I've noticed in my own business and definitely in our office We've had a lot more buyers come to the market, a lot more buyers get into the market, and a lot of people are afraid of what's going to happen with interest rates because that affects their monthly payment more than home sale prices do. When we look at active monthly listings, according to the peaks, we always generally see a peak happen in August, September, October, usually right in the beginning of the fall, the school year, and people start to slow down, their demand starts to wane as we come into the end of the year. A lot less people put their houses up in the market usually in the fall as we are getting ready for the holidays. So will we see that in 2020? That is unknown at this point in time. What I will say is when we look at the active monthly listing count, we peaked in April. Now, I had the best years of my career, or the best months of my career in June, July, and August. I sold over 33 homes in those 3 months alone. We had lots and lots of listings, but I myself went from having double-digit listings to now I have a couple, 3, 4 listings. So in my own business, I can tell you that listings have come down, even though what I see on the market is there being more listings available. Some of this is we have had a pushback from buyers saying, you know what, we're not going to bid over $100,000. We've also seen some inexperienced realtors over listing their homes, so those houses are also sitting on the market longer. So in my opinion, buyers have more options and opportunity to find a good value in a home today than they did in April 2020. So the challenge of moving forward is that the sales of the last half of 2020 were so high and there was so much overbidding that we've come down, and in the last part of the year we had a slowdown. So in 2021 we started to grow throughout the whole year. So the question is, when will listings peak in 2021? Some predict that we've already hit our peak. Some believe that we're actually going to keep climbing throughout the rest of the year, which I think is going to happen. Again, not only because we get more and more listings, but I also think that's because more and more listings will sit onto the market. There'll be a little bit more of a pushback on prices, and there won't be such a high demand of overbidding and bidding wars that are created. So 3 reasons listings may continue to decrease throughout this fall and into the winter. Pent-up selling demand. Homeowners may be more comfortable putting their homes in the market as more and more Americans are getting vaccinated. We've had a lot of protocols, people are following mask mandates, and we've had a little bit of a slowdown in the death count. New construction is starting to take off. There will be more options for current homeowners to consider when they sell. The lack of options has slowed many potential sellers in the past. We do know that during the pandemic, the home builders actually almost came to a dramatic halt. Prices went through the roof for building costs, and builders had a little bit of a pushback and a slowdown. We've also seen over this last couple of months, prices start coming back down. We're nowhere near where we need to be, but definitely have come down extraordinary from the 2020 peak of building costs. And the end of forbearance will create new listings. The end of forbearance program will not only lead to a wave of foreclosures for several reasons. Instead of going to foreclosures, homeowners will be able to sell their homes and have enough equity to more than cover the expense of selling. So I hear a lot out there, oh, I'm waiting for the crash. I'm waiting for a bunch of foreclosure markets. First of all, we have an extraordinary low amount of foreclosures, even if we count all the people that are in forbearance, if they did go into foreclosure. 2, we have an extraordinarily high amount of equity. So if you do go in foreclosure, you're not going to allow yourself to get foreclosed on. You're going to put your house on the market due to lack of inventory, high demand. You'll be able to sell that home for a relatively good price, be able to cover your costs, and probably walk away with some money. Interest rates. What are interest rates going to do? Well, we know they've been climbing. They've been going up, they've been going down, they've been going up, going down. But over this last year, we rarely see rates in the 2%, and we're starting to see them climb from the low 3s to the mid 3s. The single biggest risk to housing, rising mortgage rates, is a real possibility in the next year that could bring prices down. Further, other economic, financial, and confidence challenges could also result in a drop or flattening of home prices, even with solid buyers in place. But a drop or flattening in home prices is a far cry from the crash we saw in the Great Recession, according to Ali Wolf, chief economist at Zambia. Now, I just want to kind of put a little bit of perspective on this. every 1% that we have an increase of interest rate, we need to have a 10 to 15% decrease in home prices for your home monthly payment to be the exact same. So as we see interest rates rise, it might put a pressure on those home prices to come down in value. Now, again, we're not going to come down in value from last year, but we might come down in value from a month ago, or 2 months ago, or 3 months ago. So we possibly might have hit that peak and we'll start to slow down in appreciating value. So this is the mortgage rates, Freddie Mac 30-year fixed rate. We know in 2020, it started at 3.7%. We went all the way down to the mid twos. Some even I heard of people getting 2.25% on a 15 and a 30-year fix. We had some jump ups through 2021, and we've been going back and forth, up and down, up and down. But again, we've come up to over 3%, and they're predicting that we're going to get it up to 3.5% to maybe even touch 4%. Now, if we have this huge jump in interest rates, like we jump over 4.5%, we are going to have to see a decrease in home sale prices because people won't be able to afford that higher price. Their buying power will be limited. Also, what I do want to say is we have seen inflation have a real effect on the economy and on the pocketbooks of Americans. And as we increase, or as we continue to see that inflation really hit and truly try to understand it, even if home prices go up, it's more driven by inflation than it is driven by supply, demand, inventory, and interest rates. So we want to look at the mortgage rates jump over 3%. Many factors led to this increase, including the Federal Reserve communicating that it will tamper its support of the capital markets, the broadening of inflation, and emerging energy shortages, which compound other labor and material shortages. One thing that we can definitely look at is gas prices. Gas prices have shot up the roof. They're over 200% of what they were less than 2 years ago. Gas prices affect prices across the board. It affects inflation, it affects the price of goods, it even affects your day-to-day worker, to go to work and put more money in their pocket. Rates projections. In 2021 to 2022, Freddie Mac sees it jumping from 3.4 to 3.7, Fannie Mae 2.9 to 3.1, MBA 3.1 to 3.8, NAR 3.3 to 3.6. So you can see we're already seeing a half increase in appreciation rates over the next year. This again, even just a 0.5% increase rates, will need a 5 to 10% reduction in sales price for you to have the exact same monthly payment today. So either housing will become less affordable, which I don't think anyone wants, or home prices are going to come down, not to make housing more affordable, but just to make them the same affordability as they are today. So when we look at mortgage rates, the Freddie Mac 30-year fixed, where have they been and where are they headed? When we look at, they've come from 2018, we're almost up at 5% interest rates, which is actually historically a 40-year low. Rates are usually in between 5 and 7% historically. So anything below 5% is actually a really good rate. Now we saw them climb all the way down to low 2% during the pandemic, during 2020. We even had it into 2021. And then they started climbing up, and they've been up and down and up and down. But what we're seeing is a prediction that they're going to go up steadily and up to 3.4 to 3.7%, which again, it seems like it's going up higher and they're a lot higher, but historically speaking, they're still a 40-year low. When we look at your purchasing power, and again, this is why I always explain to people, interest rates are probably one of the most important factors when buying a home. They affect your monthly payment more than sales price does. So just real quickly, we look at a $400,000 house. If rates were 4%, you're at a $1,910 monthly payment. If they're at 2.75%, you're at a $1,633 payment. So for your house, basically have the exact same payment as you do as a $400,000 at 2.75%, the price would have to drop all the way down to $340,000. That is more than a 10%. Yeah, it's actually what I said. It was a 15% decrease in payment or decrease in sales price for your payment to be the exact same. So do we see, and all the predictions do not call for a 10 to 15% depreciation, but actually an appreciation, small, but still an appreciation. So the only thing that's going to happen over the next couple of years is housing is going to become less affordable and the purchasing buying power is going to become significantly less. According to DS News, homeownership is one of the fundamental keys to accumulating wealth in America, hence why it has been integrally linked to achieving the American dream. Not only can owning a home provide a roof over your head and a secure place to live, but because mortgage payments generally remain fixed, while rents may rise over time, a home can also be a very effective hedge against inflation. Together, these features can give homeowners an enormous advantage over renters when it comes to accumulating wealth. So again, I know throughout the years, my mortgage payment has been roughly around $3,000 to $4,000 a month. Sometimes my sales price is a lot higher, sometimes my sales price is a lot lower, but interest rates fluctuated between those and it's kept my payment around the same. I just bought a $900,000 house. It came from a $685,000 house, and my payment only went up by $200 because interest rates were a lot lower, and I was able to put a little bit more down. When we look at appreciation, which is one of the best parts of owning a home, is be able to take part of that appreciation. $111,000 of potential growth in household wealth over the next 5 years based solely on increased home equity. So if you purchased a home at $350,000, you're looking at about $111,000 of home growth. Now, you take like a $900,000 home and you take that same appreciation growth expected, you're looking at 31, you're looking at about a $330,000 appreciation growth, which would do great for your retirement savings. It would be great to be able to pull out some of that cash and invest in more homes, or invest into other different things like cryptocurrency or stocks or whatever you feel is the best advantage or path for you. So we don't have $350,000 homes in California. Maybe some places we do on the outskirts or in different areas like that, maybe townhomes and condos. But it just goes to show you that even today, where we feel that prices are at its peak, you gain a lot, or you have a lot to possibly gain in that appreciation growth. And ultimately, since your rate's going to be fixed, as long as you can afford the monthly payment today, even if we were to have a downturn or a dip, as long as you can afford those monthly payments, we know historically real estate will come back and you'll be able to experience that growth, as well as you're going to be paying down the principal on your loan. So a couple side things I just want to mention again, I'm always here to help. We can actually help nationwide throughout the whole country and even the world through our contacts. We have boots on the ground in every major city and even in the outskirts, that people and realtors that are committed to delivering 5-star service. So my business is solely based on referrals. So because of you guys, I became one of the top producers in my company, and I thank you very much. And I also want to just say, keep please sending those referrals, keep entrusting me to help you. And anyone that you think is looking to buy, sell, or invest, send them one of these market updates so that way they can be informed and see that I'm very confident and competent in what I do. Thank you very much. Cory Boldroff, the real estate guy, everywhere on the internet, always here to help, never to crush.